I'd like to introduce Brian Dunhill with Dunhill Financial, who I have known now how many years?
10. It's a decade
10?
now, yeah.
Okay, well, I can tell you that Brian called me up once and said that he was recommended to me because he wanted to kind of, augment his Paris market, and I would be a good person to know. And I said, well, if you can fix my problems, then we can talk, which is right. And he fixed my problems. And so we've been talking very well ever since. And on that note, I'm going to let Brian introduce himself and do his thing. Thank you.
Appreciate it. The truth of the story was I wanted to write off on my taxes a trip to Paris. And so I needed somebody to visit down here to actually discuss something. And then now I've been visiting Paris for a decade straight, because of Adrian and meeting wonderful people as is. I want this to be as interactive and as fun as possible. A presentation by a financial advisor about cross-border issues, about the economy, especially this time around, etc., could be very dry. So if it's dry, I blame you guys because you're not interacting enough with me and telling me what you want to talk about. So while we have a presentation, feel free to interrupt, get involved, otherwise we'll force you to make it a 2-drink minimum like a comedy club or something of this sort. We had a lovely, lovely conversation last night, which might be referenced a few times through this presentation. And one of the things that I kind of had a really enjoyable repeat of this conversation with Adrian was the structure of what a financial advisor is.
Yeah, what is it you do?
Now, a lot of people will think, okay, it's all about driving performance and how much money we can make and how we can avoid taxes, maybe some sheltered islands or something like that. I would say that that's the smallest amount of what we do. We don't do anything on small islands except for England, which has now become London ski with everything else that's going on. So there's a lot of misconceptions of what a financial advisor should be doing. And does anybody remember when TED Talks were really informative? Sorry if there was anybody. Yeah, remember those? Do you remember? I think it was the first TED Talk ever was Simon Sinek. Does everybody remember him? The Ask the Why, and that was the name of his book. And it's brilliant because he had these golden circles, and it was 3 circles. And it was companies that describe what they do. Essentially, every company can do that. What does Adrian do? She sells real estate.
No, I don't.
Okay, well, we're gonna get there, don't worry.
People buy real estate.
Okay, I stand corrected. Then the second inner circle is how. Well, how does she do it? She informs people, she talks to them, she educates them, etc. But the companies that thrive are the ones that really concentrate on why. With Adrian, it's really obvious. Why is she passionate about real estate? Because she's passionate about Paris. She's passionate about helping everybody not make some of the mistakes she's made and also learn from the things that she's done well. None. I've read your newsletter, Adrian. Works perfectly, if you look at Dell, yeah, we know that they make computers, but why do they make computers? What, to make a profit? But Apple, why do they make Apple products? They make them to make it an intuitive, easy experience for you, right? So that's why you pay a premium for an Apple product, but not the other. Financial planning to me is the exact same way. Well, what are we doing? Well, we're trying to make money. Okay, how much money is enough? Well, we can go to the old school Ted Turner quote that essentially a dollar value for a rich person is just a way of keeping score. But let's be honest, that sounds like a kid's game. I'd prefer the Andrew Carnegie way of looking at things and saying, well, hey, you want to build up an amount of money and have a reasoning to distribute it for different things. That's the why that becomes for each person. So why do we have a financial plan? Why are we doing estate planning or anything else? Is it to make the next generation rich, or is it to leave a legacy? So we really should start with why whenever we're doing any form of financial planning. So now that I've bored you with my book recommendations, which anybody that's read the newsletter probably only skims on that, or pictures of Nala.
That's his dog.
Sorry, it's that bad. She's on my socks too. So.
Oh, you didn't show me those before. Do you have a slide with Nala on it?
No, but there's a million pictures of her. I can pull up a few pictures for anybody that hasn't seen pictures of her. So I want to gauge the room, okay? I've put some slides together on what's going on in the overall economy. Don't worry, I'm not going to concentrate on the war in Ukraine. We'll talk about the bigger picture. We can talk about anything to do with being an American expat here in France, and we can talk about anything else in between. I don't have slides right now on the American expats in France because I want them to be questions from you of what really is important, because Adrian and I over the 10 years have covered pretty much every topic and some.
I'd say so, yes.
And we'll have some upcoming ones on Social Security and keeping your credit scores in the U.S. Those are upcoming.
When is that happening?
Oh, I think
well, in our next forum.
We've got the full pieces put together, so we're ready
for the August forum?
Whenever you give us permission, Adrian.
Okay.
New topics coming up. So, does anybody have preferences? Like I said, I want this to be interactive. Cool. I'll just talk to you guys then.
I can do it. I can do it.
Okay. Like I said, this is just turning into my reading list from the lockdown. So last night we had a nice conversation about Black Swan. Does everybody know the concept of Black Swan? No. This was Nicholas Tarab's book, who we decided last night was quite pompous and annoying, but he actually is quite brilliant at the same time. And now I made one drastic mistake, which I read this book when I was in Australia. And the problem with reading this book in Australia is like getting an astronomy book from the northern hemisphere and going to the southern hemisphere. There's actually black swans and a lot of them down in Australia. Black swans are supposed to be an anomaly. There are not supposed to be many of them, therefore there's not many of those events. Sorry, that kind of have to know that to understand that joke. Financial guy being funny doesn't work, does it?
We know your sense of humor.
Works better with 2 drinks, right? So what are black swan events? They're those anomalies that shouldn't come around too often, but we know inevitably that they will happen. We just don't know what they will be. And what have we had in the last couple of years is instead of a black swan event, it's been events, right? We've gone from pandemics to wars to now thousands of boats locked up over in China, creating bigger supply chain issues. We have every issue that could go wrong, and yet somehow we still have a working economy. Somehow we still have central banks that are actually pushing things through. And that's the proof of it. If we go to the next slide, what we're going to see, thank you, Vanna. What we see, and don't worry, it's just so impossible to actually read these at a distance. All we're showing is all of these different black swan events that have happened in the last 20 years and the amount of time that it took to recover from those black swan events. So in other words, even when we're talking about the financial crisis, it took us just a little over a year to actually fully recover from the financial crisis. And that was complete Armageddon. So we really shouldn't be so afraid of these black swan events. What we should be is vigilant that they're going to be coming up, and we're going to see them time and time again, and that more so they're opportunities for us.
But isn't there a difference between what happened to the economy during the pandemic and the recovery being so fast? The recovery was fast because there was really nothing wrong with the economy that caused it. But back in 2008, that was the economy that blew up. That was people being extended bad mortgages. That was something inherently wrong with the economic system that imploded on itself. And so when you had those events,
Absolutely.
And that's very worrisome.
Absolutely. So it's a good point, but it's how we can build parallels in between them. So naturally, there's three big forms of debt if you're a macroeconomist. The one is personal debt, so that's your mortgage, your credit card, anything that an individual has. Then you have your corporate debt, so companies' debts right there, and then you have government debt. All right. 2008, basically, personal debt just ballooned. What were they called? Ninja loans? No income, no assets, no job. Didn't matter. You could want a big mortgage, you get a big mortgage. Now, how do you get a mortgage in France?
Takes an act of God.
Need another drink. So essentially, that was a debt crisis that was on the personal side.
Yeah.
This time, it's a debt crisis that's on the federal side. If you exclude Germany and Australia, their debt to GDP is around 30%. Everybody else started the crisis around 100% ballpark in the developed world, and now they're around 130 to 135%. So essentially, we have a ton of debt on the government's balance sheet. Now, a debt crisis is a debt crisis. I know I'm oversimplifying it, but I don't think anybody wants me to go into the complex nature of it. A debt crisis really comes down to how do you deflate the balloon without destroying the economy? And that's why every word that Jay Powell was saying last Wednesday was so instrumental in understanding what their plan is going forward. And actually, that's a perfect segue to the next slide, because when you have an overextension of debt, the protagonist becomes truly inflation, because inflation will push the Fed to increase interest rates. Interest rates go up, and all of a sudden it slows down the economy, and we have kind of this periphery effect that, if it becomes circular, sends us into potential stagflation. Sorry, more terms that I should explain what they are. Stagflation is when inflation is going up, but the economy is shrinking. So this is one of the things that we really dislike. It's actually one of the scariest things that you can be forced to deal with. Now, why I say this is the perfect segue is, here we have all the different places where you have inflation. Now, naturally, well, most of us probably don't drive here in Paris, but you probably are aware of what fuel prices have done. Gone through the roof. It's the highest inflation item. Number two, used cars. It's beautiful. I tried to sell my car right before the pandemic and wasn't able to because I got locked down. 2 years later, sold it for 4,000 euros more than I was going to sell it pre-pandemic. I'm the benefactor of that. These are supply chains.
Why used cars?
Simple. Well, first of all, people didn't want to take mass transit at the beginning of the pandemic, but then second of all, there were supply chain issues of first getting chips to the car makers, then the car makers having to shut down, so they weren't able to build cars. So there was more demand, but less supply. So it just drives up the price. Now, essentially, when you start going down, you get to areas where 4.7% increase for shelter costs, i.e. rent, isn't so bad. That's within the realm of what we'd like it to be. But essentially, we have an overextension of inflation. Now, the four drivers of inflation right now: supply chain issues. Now, that's transitory. At some point in time, supply chains will get back to normal. Now, before last week, I would have probably said, yeah, that will probably be really soon. Now we have couple thousand boats stuck off the coast of China. It will come due, essentially, depending on which fob, which microchip company you're looking at. They're saying a year to a year and a half, maybe 2 years. But those supply chains will get back online. The second one is the overextension of debt from our governments. We're talking about trillions and trillions of dollars actually being pushed out into the system. Now, if all of a sudden the government came out and gave every single one of us a 100-euro note, do you think there would be a longer line downstairs for the bar or a shorter line? It's not a trick question. It works better if you ask your college kids. There you go, right? So therefore, that's an inflationary pressure. What did they do? They printed trillions of dollars, right? Went into the system. That should create inflation. Well, what are they doing? They're curbing it. They're reducing that, i.e. that becomes transitory in effect. And then the third thing, we've all been sitting on our duffs at home. We haven't been allowed to vacation, right, for 2 years. The average American saved the total Americans saved $2 trillion of cash forced upon us. And guess what we're doing now that they're letting us out? Spending, but we're all spending at the same time. Transitory. One day we'll run out of that $2 trillion that we saved. So these are 3 transitory events. And the fourth one is naturally the Ukraine-Russian crisis, because that naturally drives up all the commodities that those 2 countries produce. They happen to produce a lot of wheat. They happen to produce a lot of oil, a lot of gas. Now, those are the types of things where we get interesting conversations with the Biden administration, with who we thought used to be our foes. And then the interesting statistic that, does anybody in the room actually know the only region of the world that their stock markets are up this year? It was hidden inside the newsletter. Don't worry. So Latin America is actually up double digits, 13%. And one of the big reasons why Latin America has done so well is that it is one of the only areas that could actually build surplus of commodities all the way down the line. And so naturally their economies are going to do better, because what I think Egypt, and don't quote me on this number, I think they get 90% of their wheat from Ukraine. Well, let's go into land of make-believe and say the Ukraine crisis ends tomorrow. It's not going to happen, but indulge me. I can guarantee you that Egypt is not going to buy 90% of their wheat from Ukraine again, because they're not going to make that mistake twice. So essentially they're going to have to diversify where they're getting things, and Latin America happens to be the big winner right now from the commodity cycle. So the inflation essentially having 3 out of 4 components being...
I'm going to throw another component
Yeah.
at you. You know me, and I'm left of center. You know that I come at a lot of this as an economics major. There's the labor aspect too.
Mm-hmm.
I mean, there's been, in addition to the cost, push aspect of it, you described inflation. There's also been pulled in terms of tightening labor markets, and at least in the industrialized world, a greater insistence by a lot of people to earn more and to change sort of the structure in which they're operating. I just want to throw that out there, because to me that's another factor in all of this, that in the major economies like the United States and like Europe, this is becoming an overdue and important issue.
100%. I think that's the only reason that it hasn't become a bigger social issue, is that for the first time in, I can't even remember, but at least 20 years, we're actually seeing wage growth compete with inflation. And this is important. So naturally, this is important, but also scary. And I'll tell you first of all why it's important is that essentially if inflation goes up at 6, 7, 8%, and yet most people aren't getting a raise, all of a sudden their standards are decreasing, which is what was happening for 20 years, except for inflation was low, but wage growth was lower, right? But at the 2 to 3% element, it wasn't a problem. Now when we're getting to higher elements, it just becomes the potential perpetual motion of that inflation. So in other words, if the bar increases their prices, so then all of a sudden we all go back to our employers and we say we need more money. Thank goodness I don't have any staff here. They say we need more money, then all of a sudden with that more money they go spend more money, therefore that increases prices on everybody else and it becomes perpetual and inflation doesn't stop. So that's the fear on that side of those labor growths versus inflation. It can if it
now, the big question is whether the labor market is taking on a new dynamic, because we basically have people who are no longer accepting conventional modes of employment and insisting upon not working as long and dictating to employers how and when they work as opposed to the opposite. I'm sorry. Brian and I need to have dinner or something.
it does become those social issues, and yeah, now all of a sudden the United States is looking a little bit more like France. The Great Resignation has been something that's significant we'll see how long that can last in due course, because there's a lot of social elements on there that we'll see if it does. There's nothing but waiting and seeing
Well,
for that.
recession would be a great level. Serious recession would be a great level.
I hope he's wrong. So if all of a sudden we have 3 out of 4 inflationary pressures that are supply-based instead of demand-based, raising interest rates and such becomes like pushing on rope. If you guys aren't into boats, you push on a rope, it doesn't move the boat, just in case. So all of a sudden, what we're seeing central banks that don't actually have that much power of controlling this situation. But time becomes the essence that they have to really work with, and to work with those types of powers. Now, I know you guys don't want to bore you with just an economics lesson. You want just the sheer facts.
Here.
So I'll get into the questions that I know you guys are going to want to ask, which is, what's going on with the dollar? Many of you are probably earning dollars, you're getting dollars, you've got some sort of linkage to the dollar, and you've seen the dollar just go through the roof. You've probably heard some of our presentations that we've done with Adrian talking about the history of the dollar for the last 30 and 40 years. I won't bore you with that today, but I can easily send you that link. We have a flight to safe havens mentality whenever big events happen. And what have we had? Several black swan events in the last year, in the last couple of years, that have led to a flight to safety in the US dollar. Then add to that, our central banks always behave in the same way. I'm going to regret saying this on video. I already know it. But typically the order of things with central banks is that always makes Adrian chuckle when I know that I'm going to regret something. So essentially, normally America goes first, the UK goes second, Europe goes third, Japan goes fourth, and when China does it, we call them currency manipulators. We're all doing the same thing of essentially moving our currencies for what we need to do. And what do we need? We need a strong dollar right now at this point in time for America to have that weight to do the things that they need to do, right? It also happens to slow down their economy. A strong dollar means that essentially they're buying their they're buying their imports at a higher price. So when you raise interest rates first, well, how much are you guys earning in the bank over here?
Nothing.
There we go. Now, in the United States, I saw some banks that are pitching 1.5%
Big
on a
time.
savings. So, remember when you used to get actual real interest?
Like 5%?
Exactly. So what's happened since the beginning of the year? We've gone from 1.5% on a 10-year note to now we're just over 3%, right? So it's this attractive element. If you move your capital that way, you're going to get more interest. That's what they're trying to do. They're trying to strengthen the dollar. I told you I wasn't going to dive too deep into Russia and Ukraine, but if you look at the Russian ruble, it dipped big time the month after the actual crisis. I don't work for HSBC, it's a war. Sorry, HSBC won't use the word war because they're keeping their banks over in Russia. Sorry for anybody that banks with HSBC. I'm just going off on a couple of tangents there.
It's okay.
So essentially, the ruble dipped significantly. I think it was close to 50%. Does anybody know what's done since? Back to equilibrium. If you just drew a line, it looked like nothing happened. Now, essentially, they're doing things to prop it up. They increased interest rates, I think it was to 20%. They were at 14%, now they're at 20%. I still wouldn't buy it. Don't be attracted by the 20%. They shut off the ability for external people to sell their stocks. So basically the stock market's closed. I think it was 80 years the last time they closed the stock market for this long that it took them to reopen it. So now if you don't have any selling pressure but you have buying pressure, and then they're trying to force European countries to buy their gas and their oil and other commodities in rubles instead of euros, there's more demand than there is supply. What happens? It drives up the price, which is exactly why it got back to equilibrium. you're fuddling with the currency. The Federal Reserve is fuddling with the currency. Gosh, I feel so unpatriotic giving this. So essentially, right now we have a flight to a safe haven in the US dollar. It will continue until the UK and Europe start increasing their interest rates and the US is no longer the first in line. Yes, the Bank of England increased interest rates last week. Yes, the ECB is hinting at it. But right now we're getting hints of 50 to 75 basis points, so 0.5% to 0.75% in the United States. Whereas over here we're talking about de minimis amounts. So it's all about the flows. Once the US tops out and Europe and the UK start increasing their interest rates, that's when the dollar hits the top. All right? So for all of you that are sitting there waiting for saying, I want to buy, you have some time right now. Buy on these strong figures, but you probably have several months to
You
be able
think
to
it'll
continue
come
this.
to parity?
I don't do those types of predictions. I don't have my magic. No.
I'll have
Did I-
a lot more clients if it does.
I would have betted on parity had Vladimir Putin yesterday said to Moscow that he was going to go to war and call up conscripts. I've actually been trading the dollar on the basis of what's been going on in Ukraine. It's incredible. It's like, but that's nothing to count on. I think at this point, there are going to be other factors over the long term that will come into play, including sort of how the central banks operate, as well as what happens in China. If China ever finally gets its policy correct as far as dealing with coronavirus, the Chinese economy could be in a place, in which case a lot of the supply chains, a lot of the other factors could go back to something we're familiar with. That's just my analysis. So it is a question of time, but for right now, I think we're kind of in another one of these jittery spaces, mostly because Vladimir Putin jolted everybody in February by invading Ukraine, has not yet gone to the next level and pushed it.
At this point in time, what you really find on these big news items is that you end up having a newspaper fatigue. And we said in our newsletter right after the invasion that essentially within a month or so we'll have that newspaper fatigue, and therefore it won't be the main item out there driving the markets. Every single day for the first month, front page of the Financial Times, Ukraine. 31st day, wasn't on the first page at all. It was on the back page. It's like clockwork on those types of items. China will not be the main item of concern or supply chains within 3 months, 6 months, etc. The newspapers will have found a new thing that will be our apocalypse and our four horsemen, etc. So essentially the driving forces end up being the big influential forces, which right now, that is really inflation. That's what we really have to pay attention to, because that's all they really care about. So, sorry, I should have gone to that slide 5 minutes ago. Basically, this ends up being the indications of where the Fed fund level will be going in the nearer term. And what we've experienced is 20 years where basically they have a high curve and then they retract it over the course of the year. This is the first year that we're this deep in the year, and all of a sudden they're staying on track or potentially going higher. Now, the important part of this slide is really, when does it start affecting all of us and our stock portfolios long term? And the answer is, when the Fed funds rate is over 4.5%, it affects stock returns long term. Whenever it's under, it actually helps the stock market. So if we think about the simple nature of what the Federal Reserve is telling us when interest rates are going up, it's that the economy can withstand the pressure of higher interest rates. Now, part of that is because they have to curb inflation, but that's not all bad news. Going back to Finance 101, why then is the safe part of our portfolio is going down in bonds? Now, everybody knows the difference between a stock and a bond?
No.
Nope. Perfect. So a bond is a loan that you make. It can be to a company, it can be to a government, or any other entity. With those bonds, you're letting them borrow that money, they're paying you an interest, and then they pay you the money at the end. Right? With a stock, you own part of the company. So naturally, a stock is going to have a little bit more risk because essentially they have to pay all the bondholders back first. And if there's no profit, there's nothing that's passed on to you. The bondholder, even if they lose money, until they're bankrupt, you still own the bond, and they have to pay you back that money in any way, shape, or form. So bonds are typically viewed as less risky than stocks. But yet, if we look at the bond market this year, the bond side of the portfolio, if you go out the 30-year bonds, they've performed worse than the S&P 500. So the safe side of a portfolio has done worse than the risky side of the portfolio. So anybody that works with me knows that we've been for years owning more stocks than bonds purposefully because we knew this day would come, right? And what ends up happening is, think of a teeter-totter, and sorry for my bad art right there, but if interest rates move up, the value of your bonds move down. In simple forms, if you have a 1% bond, but then the market goes to 2%, which would you prefer? To earn 1% interest or 2% interest? 2%, exactly. So therefore, your 1% bond is worth less because everybody else is getting 2%. That's all that's happened. The Federal Reserve has basically increased interest rates. In increasing interest rates, essentially that means bond values have gone down. The more inflation we have, the more the Federal Reserve will try to increase interest rates, and the more hurt we'll see in the safe side of the portfolio. So the risk of basically just saying, I want to go from riskier assets of stocks over to bonds, is that if we have more inflation, there might actually be more losses by taking less risk, and yet you'll have very little recovery afterwards. Keep that face, keep that face, keep that face.
Because it's not logical.
No,
Well, it is.
it's a bigger concept over time, and that's the importance. And that's why when we come back to why are we investing, is it for money tomorrow, next week, then it shouldn't be in those bonds. It should be in cash.
So how would you deal? Okay, so how would you deal with a client who basically says, "Okay, I'm low risk," right? Because I know that you work a portfolio based on your client's level of risk, right?
That is a beautiful question, because the question isn't how much risk somebody's willing to take, it's when do they need the funds, right? So if they're low risk and they need the funds in the shorter term, then there's not much we can utilize. We have to go with those low interest rates because we can't take on those risks or the stock market risk. If it's, I need to get to retirement, it's actually building out the full view of, like on the older slide where I was showing how long does it take to get to recovery? Well, are we going to sell out if we drop this low? As long as we don't sell out when the markets drop, that's the only time we really lose money. If we hold on, we'll be fine. Does that make sense?
Okay, so when I saw everything drop a few days ago and I didn't freak out, that was like the right thing to do.
That's exactly the right thing to do. It's my job to freak out.
Well, that's what I was thinking. Brian's going to cover this.
Absolutely. Well, and that's why we have our newsletters. That's why we like to look through things in this way of the big picture. Now, the stock market is completely different. Now, I'm going to try to get out of the way of this. Now, all this is looking at the Shiller PE. Now, does anybody know who Shiller is? Robert Shiller.
He's a Yale economist.
Thank you. he's the head of the economics department over there.
I think he's retired, but I'm not sure.
He's still writing his books, so yeah, I think he still has a seat there. So, well, he coined this term. So what he did is he took the 25-year moving average of all the price to earnings ratios. So how much the company is earning versus the stock price. This is just a way to value a company. Average it out over 25 years and inflation adjust it. In other words, trying to just say, how do we value what companies should be worth? Now you can see, going back to 1997, well, we remember we had the bubble in 2001, so things got overvalued. Then they dropped off all the way until the financial crisis in 2008. And that became the ultimate buying opportunity. And here they bubbled up again. Now, why were we not afraid of valuations bubbling up during the pandemic?
It wasn't real, it wasn't an inherent problem in business or in the markets. It wasn't going to have a long-term effect.
Well, exactly. That we have price to earnings.
Right.
And all of a sudden, if most companies were not allowed to earn anything for a period of time, that we didn't know how long it was going to last, but we knew that hotels would reopen, that airlines would open up again, et cetera, them going down to zero made that spike up significantly. And airlines are not at full capacity. It feels like it at the airport, but I can assure you they're not at full capacity. So all of a sudden we have a lot of companies that are still not at their full earnings capacity. Whether they'll be back to the full earnings capacity next year or the year after, who knows? But they'll be earning more than they currently are, or they'll be bankrupt. And if they go bankrupt, good news, they're not part of our index anymore, so we don't have to worry about it. So all of a sudden, when we have all these newspaper articles that are telling us, hey, we're back at the same valuations as back there in 2001, we can say, yes, you're right, but you're not telling the full story. There's extra variables. There's a pandemic that basically kept them from doing much. Now, since January, we've had inflation. Now, inflation impacts a great rotation. How did the stock market do during the pandemic?
Great.
If you owned 5 companies, you did wonderful.
Yeah.
Facebook, Amazon, Apple, Netflix, and Google, the FANGs. Now, essentially, most of the rest of the stock market, mediocre, right? Mediocre to bad. But the thing is, those 5 companies make up 23% of the S&P 500. They're huge. Apple sold more Apple watches last year than Switzerland in its entirety sold of watches.
Seriously?
We're in
That's
Paris. There's a
seriously the
lot of
number?
Swiss watches around here.
I mean,
So-
wait a minute. In 1 year, Apple sold more watches than Switzerland has in its lifetime?
No. Than Switzerland did last year.
Oh,
Last
okay,
year.
okay.
Yeah.
In 1 year. All right.
Well, give them a few more years, and they probably will.
Still,
So-
it's impressive.
Exactly. I mean, we're at this state where you look at YouTube is going to have more revenue this year than Netflix. YouTube is Google's 3rd biggest product. So these are not small companies. They're bringing in trillions of dollars of revenue. So there's a reason that they've become the big part of the S&P 500. The problem becomes, in inflationary times, essentially, nobody wants to buy growth companies. They want to buy value companies. So a growth company is looking at a company and saying, 10 years from now, they're going to be wonderful. They're going to change the world. You know, this is where if you get people talking about the metaverse or cryptocurrencies or this or that or the other, you know, a lot of fluff. Now, essentially, a value company this is a company that's making money every single quarter. So when you have inflation, if you have a company that's selling coffee, now they buy a commodity, they mark it up, and they sell it to us. If the cost of the commodity goes up, what do? They mark up their price. So they're inflation proof. This is why typically when we see inflation, 6 months, the first couple of months, the market goes down. 6 months later, it's a perfect inflation hedge because most of the companies end up being able to mark towards that. But when you're looking at a growth company, well, is Amazon Cloud Services really going to sell more cloud services because the price of server capacity has gone up? I don't know. So the valuations start to come down. It's exactly what happened in the 1970s. It's exactly what's happening now. And I would say that we're getting overcorrected. Where exactly is overcorrected? Well, right now we're thinking ourselves into a full correction. There's no metric on it. There's great valuations out there. How far down are we going to continue to go? Well, if we just go to the 25-year moving average of 16.83, that would mean that we'd have to go down 3 standard deviations. That means we'd have a 15% drop in the markets. If we drop 15%, we'll be moronic. And this will be back where we're going to be, which is having a good 10-year bull market because valuations are golden. So just like the dollar, I'm giving you half an answer of, are we all the way there? No. But essentially, we're undervalued right now, so I'm not worried about it. And I can say that I'm not worried about it because we're still getting earnings growth. We expected 6% annual earnings growth. So remember, the big component of a company when we're buying a stock is how much they're actually earning, how much they're paying us. We expected 6%, we've gotten 8%. And the stock market's down 15%. Why? Because our mentality's changed on inflation, one big thing, inflation. And if you want to buy cheap things, America, based on those charts, is deemed as expensive. But you see, Europe, Japan, emerging markets, China, they're all cheap compared to their long-term moving averages. Japan's cheap because their central bank is not going to want to increase interest rates, right? Europe's cheap because of the Ukrainian crisis, and they're trying to figure out how they're going to stay warm next winter, right? Emerging markets in China, naturally they have their reasons for being cheap, but there's great deals out there. Who doesn't like a good sale?
This is a dumb question. What's EM?
Emerging markets.
Oh.
That's not a dumb question at all. That's a great question. I'm actually impressed that you can read any of the charts.
I'm having a hard
I'm right
time.
in front of it, and I'm having a hard time. So don't worry, we'll send these out so that you can take a look at them.
Okay,
if you really want to.
why did China do so badly?
I think we're going to have a whole session just on that.
Okay, never mind.
Well, when we're talking about the debt crisis, China, they're going through their real estate bubble over there. And the most recent item, there was that. Then they delisted all the stocks going into the Canton region, i.e. Hong Kong. So all of a sudden now they're delisting stocks on the New York Stock Exchange, which means there's a flow back to China. And then the third aspect is that they have this zero COVID policy, which means they're shutting down entire cities, entire regions when they get a few cases. So it slows down the economy in a big, big way. Mm-hmm. So,
Okay.
But
Fair enough.
I could go on all day about China, et cetera, and this is where I'm not jumping back into China, but I'm definitely liking emerging markets where we get Latin America exposure and the such.
Isn't,
You want me to go back?
I'm thinking about these earnings that are increasing and they have inflation. Isn't one of the reasons why the earnings are increasing because
Absolutely.
they're inflating?
Absolutely.
So there's a piece of the earnings that we say is driving an upward market that's just because.
But again, it goes into the margins.
The dollar is falling.
It's precisely that. So what coffee went up something like 40% last year, right? Now, for any of you that drink bad coffee, Starbucks hasn't raised their prices because they buy a forward contract 1 year in advance. In other words, they're buying next year's coffee now, right? So they can get away with it, and they're basically trying to hurt all the smaller coffee shops, i.e. the good coffee, by essentially not passing on those price increases so soon. But the importance is that it's a margin percentage. So if the commodity price goes up, the margin increases, making the earnings that much higher, which can then increase with it. So you're spot on, but it means that they're not just absorbing it. And that's a good thing.
Yeah.
Yeah. Well, long story short, this is a perfect segue for a short cartoon, So this is our bad joke of the four horsemen of the apocalypse, which we've made many references in the newsletter about it feeling like that. I guess this is a 2-year dated joke with the toilet paper, so apologies for that. I don't feel like it's that way. If we go to the next slide, what we'll really see is we've reacted and rebounded from large wars in the past. We've never had elongated periods in that. And if we go to the last slide, this is my favorite slide.
You want me to skip past this one?
Sorry?
This
Yeah.
one?
So again, it's a valuation mechanism, but it's going based on consumer sentiment. Now, when we're talking about marketplaces, well, nobody knows all the answers. Why? Because in economics, we talk about this most pragmatic being, and he's called Homo economicus. Yes, we're that corny that we called him Homo economicus. Now, he's the most pragmatic being, and none of us behave that way. Because, well, why are you investing today versus another day? Well, it just happens to be the day that you're having the conversation about it, right? Now, you multiply that times 8 billion, and that is what the markets are. 8 billion irrational human beings acting together. And that's where it becomes a social science. Now, I keep saying, I think that we're thinking our way into a recession. We're changing our behaviors because our sentiment has gotten more negative. But wait a second. We should have been negative last year when we were stuck inside, right? Now, we can go out, we can do whatever we want. We were astutely told that wages are increasing. Right? That's good news. Well, essentially earnings are coming through, et cetera, et cetera. But yet, if we look at consumer sentiment, measured by the University of Michigan, if we have any blue people over here, anytime we go under the average of 85.6, essentially you'll notice that the next 12 months we get a big rebound. Anytime we get to these high levels, when people are ecstatic, the stock market does horrible. Do the opposite of the herd and you'll outperform following what people's opinions are. There's a crude way of saying that, but I won't say it. Does that make sense? So this is why I'm not negative, why I'm not panicking, why I'm watching the stock market, why I'm watching the bond market, and it's completely rational. And as long as it fits in with your why are you investing in this certain way? I.e., if it's going to be for your retirement, well, I hope you're not you're not planning for the next 1 or 2 years for retirement. Because then we need to call the hearse, and there's a different question. Retirement is going to be a 10, 20, 30 year process. So we're still investing for the long term. So our why is 20, 30 years. And here we have these great opportunities out there because people are overthinking these valuations.
But what if you've already retired?
Absolutely. You still have a long period of time in retirement. Absolutely. So it just becomes that you might change some of the rationale inside of there. But like I was saying, whenever we've had these black swan events, essentially, when it takes a year to recover or such, we need to make sure we have enough cushion to get through that 1 year, i.e. enough of that safe money in that aspect. But we don't want everything to be sitting in cash because otherwise that inflation is going to eat away at it. Right? There's no perfect scenario. We're always taking some form of a risk, but it's which risk is worth taking and which one is going to keep us from accomplishing our why.
Yeah?
That's what I got. That's the good news.
Should I go back?
Well, we can go wherever we want.
You didn't spend much time on this one.
Well, okay. This is in simple terms. Here we have Pearl Harbor, the Suez Canal crisis, Cuban Missile Crisis, every single major military action that has happened in the last 80 years or so. And what we found is 1 month later, we've averaged 1.3% returns, and several of them are quite dismal. 3 months later, same type of thing. 12 months later, we're 1.4% below what the long-term average of 10% on the S&P 500. So the average return 1 year after a conflict is 8.6%. So anybody that says, hey, because Russia invaded Ukraine, the stock market should crumble, Well, I would basically say, why is this time different than every other time?
Manish Shana Halila Hazak. Sorry.
You'll have to explain that.
Why is this night different from all other
Ah.
nights?
and that is the biggest thing that scares me when economists or financiers say this time is different. Mark Twain, what do you say? History doesn't rhyme, but it sure does. No, repeat itself, but it sure does rhyme. There we go. Oh, I knew in this room we'd get a literary quote out there. So in other words, what we're basically saying is there's a lot of things that are going on, but there's always a lot of things going on. This is what we've dealt with for the last 80 years, and yet we've never had a decade in those 80 years that we've lost money in the stock market, and we've averaged 10.5% per year in that stock market. It's not changing.
Okay, so in other words, we shouldn't be afraid to invest.
No, not at all. It's more of an opportunity than it is something
And how
to be
does that
afraid
compare with a real estate investment?
of. Ooh, that's a beautiful question. Oh, geez. Where's the whiskey? So, real estate in a funny way. So actually, Schiller, who we were talking about earlier, the real estate index is named after him. So essentially, when it comes down to it, he found the best way of analyzing